Verizon Communications, stock ticker VZ, just released its Q2 earnings report. So in this video, we'll be analyzing the stock, looking at the earnings report, digging into the dividend metrics, and also looking at its future growth prospects. So let's go ahead and dig into it. We can see the company is currently trading at $34.24 per share, and over the past year, despite the market being up quite a bit, this company is down around 23.5%, and year to date, down 14.66%. Now, obviously, the huge appeal for a lot of dividend investors is that starting dividend yield sitting at 7.68%. And if we look at the dividend history for this company, you can see they've been increasing the amount they pay in dividends for 18 consecutive years. If we scroll down and look at that chart, you can see the steady history of increasing those dividend payments. Looks like in 2013, they were paying out around 52 cents per share every single quarter. Jump forward to now, it's now sitting at around 65 cents per share. So the dividend growth hasn't been phenomenal, but it has been consistent. But let's go ahead and dig into that earnings report that was just released. I'll go ahead and scroll up, and you can see Verizon non-generally accepted accounting principles earnings per share of $1.21 beats by about 4 cents, while revenue of $32.6 billion missed by around $720 million. Now, the stock was up slightly after this earnings report, maybe around 2 or 3%. But perhaps more importantly is Verizon is maintaining its full year earnings forecast, which for a lot of Verizon investors is exactly what they wanted to see. Now, to point out a few more things from this earnings report, I'll go ahead and scroll down, and we can see for 2023, Verizon continues to expect the following: total wireless service revenue growth of 2.5% to 4.5%. That's about what I would expect. I don't think you'll be seeing any rapid growth from Verizon anytime soon, but we do want to see reliable and sustainable growth from the company. They're expecting adjusted earnings per share $4.55 to $4.85 versus the $4.68 consensus. Now, this is what's interesting to me. Capital spending in the range of $18.25 billion to $19.25 billion. And I do want to explain why that's interesting, but I want to point out something else first. Let's go ahead and jump back over here and go to the balance sheet. And if we scroll down, I want to look at long-term debt. Scroll down just a little bit further, and you can see long-term debt December of 22 right here and the last report right here. So it's pretty clear long-term debt has been climbing up to pretty high levels over the last few years at a pretty rapid rate, and it's now sitting at a very high level that's not really comfortable for me as an investor. Now, what's the reason behind this high level of total debt and also the high level of capital expenditures? Well, if you've been keeping up with the company, over the last few years, they have been looking to increase its 5G network build out. If we take a look at some of the guidance that was given in early 2021, here's the quote: Verizon will spend even more to put those airwaves to work. It's committing $10 billion in capital expenditures in the coming 3 years to get the spectrum deployed as quickly as possible. New revenue is expected to come from 5G enterprise, particularly including private networks and mobile edge computing, and expects to focus on the mid-band spectrum acquisitions on fixed broadband to homes, targeting 30 million homes by the end of 2023. And again, that was a quote given in early 2021. So that high level of capital expenditures and high level of debt is pretty much due to this 5G network build out. Now, high levels of capital expenditures will lower your free cash flow, but if they can roll this out like they are hoping to do, and if they're nearing the end of increasing the 5G network build out, then I think we will see a nice spike up in free cash flow in the coming years. And remember, free cash flow is where the dividends are paid out. So with that high dividend yield, obviously we want to know that that dividend yield is sustainable, sitting at 7.68%. If that free cash flow growth rate is growing at a rate faster than the dividend growth rate, that's going to make me feel pretty good as an investor. And let's go ahead and look at the dividend payout ratios for Verizon. If we come here, we can see the dividend payout ratio sitting at around 50%, but come down a little bit further and we can see the cash flow payout ratio actually only sitting at around 30% for the trailing 12 months and for the forward-looking cash flow payout ratio. So that's actually pretty comfortable levels, especially with a high starting dividend yield and for a company that's increased dividend payouts for quite some time now. So even though we have seen a pretty deep dive down with this stock, I do think that dividend is still safe. And if everything goes as expected with the 5G rollout, then I think the free cash flow will increase and will make that dividend sustainable. But now the big question we need to answer is the company trading at a good value at its current prices? So to answer that, we need to jump into my stock valuation spreadsheet to look at a few different valuation models. And like always, if you'd like to be able to download this spreadsheet and join a community of dividend investors, then you can head over to my Patreon page at the link in the description. Let's go ahead and come up here and plug in VZ and hit enter, and you'll see all this data will automatically load in. Now, like we've already talked about, 365-day change chart down quite a bit. Dividend metrics we've talked about, they're currently paying out around $2.61, giving them a high starting dividend yield at 7.62% with a 50% payout ratio. Now, here's what's interesting. Analysts currently have a target price of around $42.52. Institutional ownership around 63.8%, so not too high. Now this is really interesting. This is actually the lowest beta I've seen out of most of the stocks I've analyzed over the past few months, a beta of just 0.38. So you should see very, very little volatility from this company, which to some people is actually a pretty attractive thing. So let's go ahead and jump to our first valuation model, and this is going to be Graham's valuation, a valuation model invented by Benjamin Graham to calculate intrinsic value. Now the first thing we need is our earnings per share. We then multiply that by our growth rate projection. And if you look at analyst projections again, they're all projecting pretty slow growth rates, so we're just using 1.5. We then multiply that by 4.4, which is the average yield on AAA corporate bonds, and then divide by Y, which is the current yield on AAA corporate bonds. And at the time of this video, it is sitting pretty high due to market conditions at 4.72. But when we plug all this in, we come to an intrinsic value of $40.65 per share. Now again, keep in mind this could be even higher, but that current yield on AAA corporate bonds really pushing down this valuation quite a bit. But let's go ahead and look at our next valuation model, and that's going to be the discounted cash flow analysis. I'll go ahead and zoom in just a little bit, but basically the value of a company is dependent on how much free cash flow it's going to be able to produce in the future. So what we need to do is project a growth rate to the future free cash flows for this company. So what I've done is I've plugged in the historical free cash flow over the past few years so we can see those year-over-year free cash flow growth rates. Now, like expected, due to those capital expenditures, the free cash flow has been a little bit lower over the past couple of years. With that being said, I'm projecting a free cash flow growth rate of around 2.5% to the future free cash flows for the company, and I'm applying it to the 2023 projected free cash flow. So I use that growth rate for all of these years right here and the terminal value, which is the sum of the future free cash flow past the year 2031. I then found the present value of all those future free cash flows and added them together, added the company's cash and cash equivalents, which isn't very high, subtracted out the total debt, which like I already talked about, sitting at really high levels right now. I know that's a concern for a lot of people, but once we've done that, we get the equity value, divide by shares outstanding, and we come to a discounted cash flow price per share, sitting at around $33, pretty close to that current trading price actually. Now the next valuation model I typically look at is the multiples valuation, but for a company like Verizon, I really feel like the only good comparable is AT&T, and I think you should really have more than just one comparable when you perform this valuation, so I'm not going to use it in this scenario. So that means the last valuation model we're actually going to look at is going to be the dividend discount model. The idea behind the dividend discount model is we should be able to value a company based on how much they pay out in dividends and how much that dividend is increasing over time. So what I've done is I plugged in the quarterly dividend payouts over the last few years so we can see how much the company pays out each year, and now we can see our year-over-year dividend growth rates. We have about 1.99%, 2.11, 1.91, and 2.03. So it's pretty clear they're staying pretty close to a 2% dividend growth rate average, sitting at 2.01. So I'm actually going to stick with that, and I do think that's sustainable with their current cash flow payout ratio and the projected free cash flow growth rates. So again, moving forward, I'm projecting a dividend growth rate of 2%, discount rate of 8%, and that gives us a dividend discount model price per share of $44.04. If we go ahead and jump over to our output tab, we can see the three valuation models that we use. Graham's at about 40.65, DCF 32.95, and dividend discount model sitting at 44.4. When we average those three together, we come to an intrinsic value of $39.34, a decent bit higher than that current trading price. So with a 10% margin of safety, you could see the acceptable buy price for this company sitting at around $35.40, with a 20% margin of safety, the acceptable buy price sitting at around $31.47, so it wouldn't be quite in that buy range at that price. Now the big question for a lot of people is, should you consider adding it to your portfolio at its current prices if it is a little bit undervalued? And I actually think it depends on what your investing goals are and where you are in your investing journey. For example, it does look like it's slightly undervalued, and if we jump back over to Seeking Alpha, obviously it has a very nice starting dividend yield, and like we saw earlier, it does look like those dividend payouts are sustainable. But with that being said, it has very low projected growth rates. So maybe if you're someone nearing retirement or someone who's looking to live off of dividends within the next few years, Verizon could potentially be a play that you should consider. But I think for most investors, we want to look for companies that have higher projected growth rates and companies that will be able to continue to increase their free cash flow and dividend payouts at a rate much higher than Verizon will be able to. So for me personally, even though they have a nice starting dividend yield, it looks like they're a little undervalued. I'm not really considering adding this company to my portfolio right now. I want to find a company that has much higher growth rates than Verizon so I can see share price appreciation and dividend growth in my portfolio. So there you go, there is a quick analysis on Verizon. Go ahead and let me know what you think of this company in the comments down below if you plan on buying or selling. If you'd like to be able to download the spreadsheet, you can head over to my Patreon page at the link in the description. Seeking Alpha is also currently running a 14-day free trial at my link in the description, so if you're interested, be sure to check that out. But with that being said, thank you guys so much for watching the channel, and please don't forget to like and subscribe.